Hi, Peter Jones, Chartered Surveyor, author and property investor, and in this short series of videos I want to look at some of the changes that have come in over the last few years which are affecting or which are going to affect us as landlords and investors. Now the first one I want to look at is Section 24. Now before you switch off and think this is old news, the ridiculous thing is I still meet experienced and established landlords and investors who don't realise the implications that this is going to have upon them and the effect it's going to have on their portfolios, or more particularly on the tax which they'll have to pay on their portfolios. So just as a quick summary, back in 2015 the then Chancellor George Osborne decided that in order to curb the attractiveness of buy-to-let, in order to level the playing field is how he put it, so that first-time buyers and owner-occupiers will have more of a look in and not be outbid by those nasty buy-to-let investors, he decided that what he was going to do was he was going to restrict the amount of mortgage interest that we can offset against our rent when we're calculating how much profit we've made for tax purposes. So basically, before 2015, if you had a mortgage and if you were paying interest on that mortgage, then all of the interest could be deducted from the rent. Whatever was left over was then the amount which you would then pay tax on, along with taking off other costs and so on and so forth. Now, he didn't bring that to zero on day one. What he's done is he decided that it would be phased out. So over a 4-year period, the amount that you could offset, the amount of mortgage interest that you could offset, reduced by 25% per annum. So we've just had the first year where we could only offset 75%. In this current tax year we're only going to be able to offset 50% of our mortgage interest, and the next tax year we'll only be able to offset 25%. Now it doesn't quite go down to zero, because this is what happens. When we get to 2020 and we're not allowed to offset any mortgage interest, we will actually be able to have a tax credit of 20% of our mortgage interest, and your accountant will be able to explain more fully what this means. But what this means in practice is that obviously if you have mortgages on your properties and if you're paying a lot of interest at the moment, and if that's been making you not pay much tax, your tax bill is going to go up a lot. Now in theory this is going to hit higher taxpayers, those in the 40% and above brackets, more than those who are in the 20% tax bracket. But don't be fooled, because there's plenty of landlords who at the moment are in the 20% tax bracket for income tax purposes, who don't realise that the consequence of having the mortgage interest restricted could actually push them into the higher tax bracket, so they end up paying more tax, not just on their property rent, but on all their income. As I say, I still meet landlords and investors who don't fully understand this. By 2020, when they sit down with their accountant and they look at their tax bill, they'll have a much better understanding, but better to be forewarned to understand what's going on now so that we can prepare for it. Now, a consequence of Section 24 is that over the last few years, many landlords and investors have started buying into a limited company, because as things stand at the moment, limited companies are not affected. If you have a limited company, you can still offset all of your mortgage interest or interest on other business loans against your rent when calculating corporation tax. What the Chancellor did recently in the budget, which was a bit sneaky and which didn't get very much press, is that he froze indexation relief for limited companies. What does that mean? Well, indexation relief was really the limited company equivalent of capital gains tax allowance. So what it means is that whereas in the old days if you bought a property and then it increased in value and then you sold it, when you calculated how much corporation tax you paid on the gain between the purchase price and the sale price, you'd be able to inflate away part of that gain by using indexation relief. Basically inflation, RPI, CPI, whichever measure it was they used, was used. And there's tables which your accountant can get hold of, and you can get hold of these online as well. You can work out how much you can reduce the gain by, or in technical terms, actually just increase the value of the property when you bought it, so that you've got a bigger figure to take off the sale price, if that makes sense. Don't want to get into technicalities. You could do all that, meaning you could have a smaller gain, meaning you pay less corporation tax. But from January 18, that's all been frozen, that won't happen. So if you buy a property in February 2018, for example, and then sell it, I don't know, in 2030, and say it's doubled in price, say you bought it for 100,000, say it's doubled in price by 2030, you will pay corporation tax on the whole of the gain. So that's something new. So there we are. They sort of take with one hand and give with the other and then take it away again. Because many investors and landlords are buying properties into limited companies to get around Section 24 and the mortgage interest relief. Now we're going to get clobbered by the equivalent of limited company capital gains tax. But to be honest, capital gains is charged at the moment to an individual at 28%, whereas by the time you sell a property in a couple of years' time, unless there's been a change of government and a change of tax regime, it looks as if corporation tax could even be down to 17%. So although you won't have a capital gains tax allowance, the amount of tax which you'll be paying as a company will be less anyway, so it probably evens itself out, 6 of one, half a dozen of the other. So there we are. One of the consequences of the whole Section 24 thing is that those landlords and investors who have woken up to this have been doing one of three things. They've either been doing nothing, which is fine. If they can afford to pay the extra tax, then they've just taken it on the chin. Or they've been talking to their accountants about moving their properties from their own name into a limited company. Because remember, this only applies if the properties are in your name. It does not apply to limited companies. So if you can move them, that's great. Now, if you talk to a dozen different accountants, you'll probably get a dozen different answers as to whether you can move your properties and how you can move your properties in the most tax-efficient manner from your own name into a limited company. There are ways and means of doing it, and I've heard talk that you can even do it without getting embroiled in capital gains tax or stamp duty, but you need to talk to a very specialist accountant who can help you to do that. But the third thing which some investors and landlords have been doing, of course, has been selling up in something of a panic. And certainly where I invest, the number of properties that have been going through auction and selling through auction has increased dramatically over the last couple of years. It used to be the case that there's hardly any properties being sold in auction. If you go onto Rightmove now and do a search on my investment area, you'll see a dozen or more properties at any one time which are all heading for auction, which is really interesting. What does that mean for us? Well, it means that if you're buying, this is probably a great time to be establishing who those panicky landlords are and maybe buying properties off them, or seeing if you can do a more creative deal with them. See if you can acquire the properties using a lease an option, and then you could even sell them on using a lease option, or using some other creative way of taking control of the property, which doesn't necessarily mean buying the property. So there we are. We live in interesting times, and Section 24 has certainly sort of put a cat among pigeons, hasn't it, as far as property investing is concerned. So here's to successful property investing.